Hyperinflation is here. The Fed is printing money. Buyers beware, they're dooming us all. That's the latest rhetoric coming from Wall Street, and wealthy investors are worried about the rising costs. While, on the other side, the Fed is trying to assuage fears by calling this inflation transitory inflation. Investors like Ray Dalio aren't buying the Fed narrative and telling everyone to buy crypto, buy real estate, buy stocks. They believe that the worst is yet to come, but I have no doubt you've heard the same story from multiple different people. I can say with a great deal of confidence that they're probably wrong. As of November 11th, 2021, the year-on-year inflation rate for the US was 6.2%. The latest figures sent markets tumbling as it exceeded our expected inflation of about 5.9%. Before we delve deeper, let's recap how we calculate inflation. The Bureau of Labor Statistics creates a market basket of goods. These are goods and services that everyday consumers will spend their money on. They measure the change in those prices over time to find the rate of inflation. The three big categories are food, energy, and other items. Big ticket items like rent and education aren't included in this calculation. One trend that we have seen since the economy has begun recovering from COVID-19 is rising energy prices. Energy prices have gone up by over 30%, which has skewed the overall CPI much higher. Oil saw a double-digit increase last month alone as the economy has started heating up. Electricity grew alongside natural gas, and some of it is seasonally explained. It's winter, it's colder, the demand for space heating is up, but these numbers should never be this high. You might be wondering why gas prices are so darn high. Biden? Probably not. When COVID-19 swept the world, gas prices dropped because people weren't traveling as much, and we were in the middle of a recession. Aggregate demand was down, and we saw deflation. To counteract the rapid fall in gas prices, the Organization for Petroleum Exporting Countries, alongside Russia, slashed global oil production by more than 10 million barrels per day. The US has been pressuring OPEC to produce more oil to drop global prices, but the supply has only been increasing by about 400,000 barrels per month. While the US produced most of its own oil, it's also dropped oil production from its peak of 13 million barrels per day in 2019 to about 11.5 million. Companies like Exxon and Chevron aren't keen on producing more, not when they can focus on capital restructuring and debt servicing. The US can't force domestic oil companies to produce more oil outside of wartime, so the supply of oil is going to be at an all-time low. Even Canada, our neighbor to the north, can't bail us out. They're our biggest oil trading partner, and they supply more than 3.6 million barrels of oil per day. But that distribution is through pipelines that are already at full capacity. These higher prices are going to be the norm until supply catches up to meet demand. This won't be a quick fix either. There will be a lag between the start of new production and the fall in oil prices. These energy prices have resounding effects on the rest of the supply chain too. If energy is expensive, transportation becomes more expensive. Storing and refrigerating food becomes more expensive, and server technology to maintain all our websites also becomes more expensive. Energy costs are keystone costs that affect all supply chains, and without it, we run the risk of stagflation. Stagflation is when there's slow economic growth combined with higher inflation. It's worse than a recession, and you can't really spend your way out of it. When there is a recession, the government can pump more money into the economy and fix demand-side problems. People who get stimulus checks, for example, would spend that money at businesses and keeping businesses in business. People who get those stimulus checks will spend that money and keep small businesses in business. If there's a supply shock, then no number of direct transfers can resolve the problem. The only way to fix stagflation is to boost supply by fixing supply chains, and that takes time. We could revamp infrastructure, but it'll be years before we see the returns from that investment. And some industries just don't have that time. Semiconductors are another area where we face a supply shock. It's a big reason why we find that used cars are more expensive, because companies like Toyota and Ford are struggling to get a hold of computer chips, so new buyers must settle for used cars. The chip shortage hit electronics hard, but since they aren't counted in CPI, we don't really have a lot of strong numbers. We know that getting the latest game console or computer hardware is harder than ever because of scalpers, but they can only get away with their behavior while the supply of new technology lags demand. The Fed narrative seems to be supported by more data. Now, you might believe that it's just them covering their behinds to skirt the fact that they did print nearly $9 trillion during the pandemic. While the Federal Reserve has increased the supply of the US dollar by 40%, there isn't any strong evidence that inflation of commodities is the result of easy money policy. With 40% dollars, we didn't see 40% more inflation, at least not in the CPI. A lot of the money printed by the Fed ended up in asset classes like stocks, bonds, and crypto. Many investors and banks who were afraid of inflation pumped their money into assets, hoping to get a higher rate of return than inflation. Therefore, the real estate in Austin has become more expensive, while the price of clothing fell. There is inflation, just not the kind that would directly affect consumers. We don't know how bad the stimulus policy has affected our housing crisis, but that might be one of the only ways that printing money has harmed the livelihood of ordinary people. The issue is supply side. And all we can really do is hope that our supply chain recovers such that inflation returns to its natural 1 to 3%. It will be a bumpy ride, but no, it's not hyperinflation. So Ray Dalio, Wall Street investors, there's a good chance that you're worrying over nothing. Now, I would not be a good student of economics without saying clearly, I reserve the right to be wrong. You do not get an education in economics unless you're willing to acknowledge that economists suck at predicting things. And there's a good chance that our struggling supply chains make it impossible for capital investments to restructure, at least in the short run. It is possible that our supply chain shortage makes it such a barrier for new investments that the hoarding of asset classes increases. But based on the data available, it seems that this inflation is transitory and that we're not struggling with hyperinflation. Please like, comment, and subscribe if you like this content and share it with all your friends. It really helps, and growing this podcast is the first step to exploring more of the fundamental myths of modernity.